Good evening once again, and thank you everyone for your patience. Hope you've gone through the shareholders letter. Now, once again, to begin with, I would like to request Bhavish Agrawal, Chairman and Managing Director of OLA Electric, and Harish Abichandani, CFO of the company, to take you through the results. Over to Bhavish and Harish.
All right. Hi everybody. Good to speak again after a quarter. And this is Bhavish. So this is practically, I think, our first quarter in the public markets that we are giving you an update on. Before that, actually, in the last quarter we had done the IPO, and just 3 days after that we had quarterly results. So, and this time we've also changed our format of how we are updating all of you. We've also changed the way we are. Some financial metrics are being, told more around how industry standards are on revenue, etc. So I'm assuming most of you would have gone through the shareholders letter that we've written. We've tried to capture all the financials and some operating commentary also in it. What I'll do is I'll just give you some highlights. My remarks will be very short, and then we'll get into questions directly. So this quarter actually, has been a good quarter compared to last year. If you see, our revenues have grown about 40% over last year, 38.5. Deliveries also almost touching 1 lakh, 98,000+. And gross margin, especially for the auto segment, is 20.6%, which is flat quarter on quarter, whereas year on year it's about 12 points up. And this is despite much more enhanced competitive dynamics in the industry, which I will talk about in my remarks. So I think key highlight for us in Q2 has been that we have maintained our market leadership. Market share is around 33%. And this is also a quarter when competitive action got aggressive, and we will comment a bit on that. One key area of focus for us going forward on the market is to expand distribution. We have about 780 odd stores right now, and we are in the process of expanding company-owned stores to about 2,000 by March, which is just about 4 months away. And in addition, we've also in September launched our network partner program, under which third parties like multi-brand outlets, other people who are already in the auto ecosystem from a retail perspective can also sell our products. We have about 1,000 such partners live with our products now. So the front-end distribution is an important focus. We continue to scale. And as you'll find in the document, for us, each store is, does almost about 130 sales per quarter. And that's almost 2 to 3x of industry average. So we have much higher productivity per store than the industry, and we are expanding our store network. So we actually hope that we will be fairly competitive in terms of depth of distribution with about 2,000 stores of ours. In addition to that, the network partner program will amplify the distribution network. Second, I think more on an industry commentary, for a few quarters there have been questions that how is EV penetration doing? Now, actually, if you see this quarter and even then after that, October last month, we've seen EV penetration start to hit a bit of an inflection point, especially if you see the scooter EV penetration. Because when you see overall, it kind of gets averaged out due to the motorbikes. But when you see scooter EV penetration, in June to September this year itself, it's gone from 16% to 21.5%. And, even from September last year to September this year, it's gone from 13.5% to 21.5%. So very significant increase in EV penetration despite FAME subsidies and all tapering off significantly. So we believe that the EV scooter penetration is actually at an inflection point now. And if you also look at it regionally, many states like Rajasthan, UP, Maharashtra, the big states are around between 30 to 45% EV scooter penetration. In fact, Rajasthan is actually 47%. So this shows how while some states are racing ahead, eventually all states will get here. So it's a question of just supplying, adding distribution. So that's a very good, encouraging sign in the industry. I know in many ways, while on a daily, monthly level, there's a lot of operating noise, the fundamentals of the EV transition of India remain very strong. And as the leader of that transition, we actually feel very confident of this inflection point. Another commentary which played out, another point which played out in this quarter is, as we had launched our mass market portfolio a couple of quarters back, this quarter is where it really came into its own. We were able to supply at almost full demand. Quarter on quarter, our mass market products, the S1X portfolio grew 15%. And despite the growth in mass market, our premium market products continue to be a majority of our revenues. We have a very good balance between the two products. And another point you'll find in our shareholders letter as you read deeper would be that our margin profiles across both mass and premium are actually not very different, because it's built off a platform architecture. So we are very easily able to control BOM costs as we go down the mass ladder and hence make similar gross margins. I want to reiterate our strategy, which we've been consistently following over the last couple of years, or ever since we started this company. And every quarter I would like to give you guys an update on how our strategy is progressing. There are three key elements of our strategy. Firstly is broadening our product portfolio. In the scooter segment, anyways, we have the most largest product portfolio with 6 scooters from 75,000 rupees to 1.5 lakh rupees. And in August this year, which is in Q2, we launched our motorbike portfolio, especially the Roadster portfolio. And the first bike is on track for deliveries next quarter. So we are on track with our motorcycle launch and execution and delivery roadmap. In addition to just the Roadster series, we also announced a bunch of other motorcycle products which will come out through the next year or two, as well as the Gen 3 platform, on top of which more scooter products will be coming. And you'll see a chart in the shareholders letter where it shows you just a time view on some of these products. There's been some media speculation in the past, and about us working on three-wheelers. So yes, we are building three-wheelers. The beauty is that it shares the same platform as our S1 in terms of electronics, battery architecture, powertrain. Only the mechanicals are different. So you see the three-wheeler product roadmap also in that chart. So net, very strong product lineup over the next 2 years, almost 20 plus products to be coming over the next 2 years. And more than actually one per quarter. So we are quite excited, and starting next quarter itself, we will start seeing a lot of product rollouts from us across categories. So that's strategy number one, which is broadening our product portfolio so that the EV transition, EV revolution can be more broad-based across the 2 and 3-wheeler industry in India. Second strategy for us is continuing to expand our distribution and service network. And like I mentioned in a previous point today, that we're going to 2,000 stores. We already have 1,000 network partner stores, and we will increase that also by March. So net by March, we'll have more than 3,000 retail points, 2,000 of ours and a minimum of 1,000 of network partners. Now these stores for us, as you know, are co-located with service infrastructure. So as we are expanding our sales network, our service network is also getting expanded. Over the last quarter or so, especially in Q2, we had a bit of a capacity challenge in service. Our sales have expanded much faster than we had expanded our service network. But I would like to inform everybody that almost all of the backlog that was there because of the capacity issue has been solved now. And we've added capacity also, as well as we've as a one-time solved almost all of the backlog, more than 90-95%. And now, in service, our T+1 service, which is, like, say, if you give your vehicle to me to service today, either today or next day I return it to you, is almost 80%, which is more or less at industry standards. So, but we are continuing to expand both sales and service infrastructure. Our focus is to we've invested very solidly as well as deeply into the back end of the business, which is the factories, the manufacturing, vertical integration. We are now focused on really expanding our distribution to be as close to the customer in both sales and service as we can be. So that's strategy number 2. And in the letter, you will also see some maps and how the network is densifying already. The third and most important in my view is a continuing focus on technology, innovation, and vertical integration. So in August this year, again, just 2 months back, we had announced our Gen 3 platform. Now, as you all might remember, and since you all track the company closely, Gen 2 over Gen 1 had saved about 20% of BOM cost and hence gross margin for us. Now, Gen 3 over Gen 2 will be a similar saving. And I'm actually very happy to announce that while we had said Gen 3 will come out in August next year, we are now bringing out Gen 3 products 2 months from now, which is January. So, the S1 scooters on the Gen 3 platform will be coming out in January. And then through the year, the whole 20% of margin savings will be step by step coming in. So some savings will come in January, and then many more every quarter as all of the Gen 3 technologies come into play. So that's a very good highlight. Our engineering teams and the manufacturing teams have really executed well to bring in very significantly from August to January our timeline on the Gen 3. So 3 strategies, like I said, broad product portfolio, very large distribution, company-owned as well as partner, and continuing focus on technology innovation and vertical integration. And finally, on the vertical integration point, I would like to share with all of you that our cell project continues well on track. There's a program timeline in the shareholders letter that you can refer to. We are on track for productionizing or starting commercial production in Q1 FY26. This quarter, our testing as well as our trial production continues to be ramping up. We are seeing good improvements in process accuracy, in yields, etc. There is still a journey to go. We are being very rigorous in terms of testing and process quality for the cell. So that's why Q1 is the timeline where it will get commercial production started. And then there are some images and videos for you to refer to on how the Gigafactory is shaping up, as well as some products that we've announced. Very quick commentary on financials, and then I'll open it up for Q&A. So on financials, you can see year-on-year gross margins have improved significantly. EBITDA margins have improved significantly. Quarter on quarter, our gross margins are flat. Now, we have had a 3 percentage point improvement in gross margins due to BOM cost savings, due to our vertical integration and technology. Part of that, which is about 1 percentage point, we've invested back into discounts to grow. And then 1.5 percentage points is actually a one-time timing issue on PLI certification of our new S1X products, all of which is now done. So this quarter, Q3, we have the full PLI recognition for the S1X portfolio also. And a general commentary I want to give on gross margins looking ahead also is because we've also pulled in Gen 3, and in addition to Gen 3, we've been doing a lot of other technology and manufacturing integration work. We can expect to see almost every quarter a continuous improvement on gross margins, right? And part of the margins we will keep to improve the bottom line. Part of it we will invest into growing the market or competing with aggressive competition. And our own estimates, we have a chart there towards the page number 8, I think, where you can see how our cost structure in our own estimates versus competition's cost structure. These are 2 incumbent competition. We have about a 20% advantage on just BOM cost for a better featured product. Now, this advantage only gets stronger because of our technology and vertical integration. And in terms of, just to summarize this point, so in terms of gross margin, we expect about a 20-point improvement as Gen 3 plays out over the next 12 months, step by step. And then as our own cell comes in, that's another 7-8 points of gross margin improvement. So you can see a nice table a nice chart at the end on how, even without incentives, how our gross margins are looking like at a target level. That's a steady state focus. We're building towards that. And every quarter you can expect to see gross margin improvements from us. Now, in addition to gross margin on financials, I also want to comment on EBITDA a little bit. Now, on EBITDA, there have been some one-off expenses. If you exclude that, our operating expenses are actually flat or slightly 1% lower quarter on quarter. And we are focused on some cost efficiencies, and we do expect our operating expenses to actually be flat or maybe slightly lower over the next couple of quarters as we continue to scale distribution and hence revenue, and including product portfolio. So revenue keeps growing, and operating expenses will largely be flat or probably even down over the next couple of quarters. We have had in terms of one-off expenses, there is one warranty expense that we have taken in this quarter. Now, in FY24, our warranty as a percentage of revenue was about 5.5%. Now, for this year, in the last quarter, we are accruing about, I think, 2.5% of revenue as warranty. So we are still waiting for our estimation model to stabilize. There are some one-time expenses in the warranty due to this backlog. But over the next couple of quarters, we will stabilize this, and if we need to increase provisions, we will. But broadly through the year, I expect warranty to be at or lower than last year's number of 5.6%. So that's broadly the commentary, and now I will actually let you guys ask your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Chandramouli Muthiah with Goldman Sachs. Please go ahead.
Hi, good evening, and thank you for taking my questions. My first question is just around some of the one-offs that Bhavesh spoke about just now. So there seems to be a pickup in both other expenses and wages quarter on quarter, in spite of having flattish or slightly better gross margin performance quarter on quarter. So just trying to understand around the IPO, were there any flotation costs? Were there any appraisal costs? And also if you could size out maybe in rupees crores what those expenses were, and also just the warranty one-off that you might have taken this quarter, what the size of that could be.
Sure, Chandra. I'll take a first attempt, and then maybe Harish can add some specifics. So there were actually 2 or 3 one-off costs. Obviously, there was an IPO-linked cost. Then there was this annual launch event that we do. There were some costs linked to that. And then thirdly, obviously, an annual appraisal, which was also put, which happened in this quarter. So all included, I think these 3 added up to about 30-odd crores, Harish, 36 crores. Then in addition, warranty was the one-off that we did was about 64 crores. And like I said, I think my commentary on that is we are provisioning 2.5% of revenue. Over the next couple of quarters, we will watch that. We do expect, last year, like I said, warranty was about 5.6%. We do expect warranty to be lower than last year across this year. If we need to increase our provisions after a quarter or so, we might do that also.
Got it. That's helpful. Second question is just around the motorcycle launches. You mentioned we will start next quarter. So just trying to understand, I mean, we've done the launch in August. So do we have any order backlog color or any sort of demand color that we're able to share around the Roadster portfolio, which might start getting delivered in the March quarter?
Yeah. No, so the Roadster series has generated a lot of interest, and there are 3 products there, the Roadster X, the Roadster, and the Roadster Pro. Right, and these 3 are coming in sequence. The first Roadster X is coming most likely around the March timeline. Then Roadster will happen most likely around the May timeline, and then Roadster Pro towards the end of the year. Now, interest is very high. Today, I won't be sharing any specifics around reservations or orders and all. By the time next call comes around, I will definitely share that. But, there has been very significant interest on social media, on our stores, on our website for really understanding about this product, as well as a lot of people booking reservations for it.
Got it. That's helpful. And my last question is just on the points that you made around efforts to bridge the service network gaps. So there is a lot of numbers floating around. I think there are some press articles which have spoken about, 85, 90,000 service requests, incoming service requests per month. I think our installed base of vehicles is close to 800, 850,000 vehicles at this stage. So if you could just give us some clarity on what are the run rates that we have on a monthly incoming, vehicle service request.
I think there are a lot of numbers floating around. So even if you take the 80,000 number from the press, if you think of any typical OEM product, it has 1 to 2 scheduled maintenance per year, right? So if you have, let's say, 1 million install base, that's 2 million, 1.5 to 2 million service touch points per year. Now that makes it about 1.25 lakh a month, right? So, and when these 80,000 are not all complaints or issues with the product, many of them are regular check-ins of the customer scheduled maintenance. Many of them, more than 2/3 are actually just minor labor things, something feels loose or the guy actually doesn't understand how his software works, so he comes in and then we explain to him. More than 2/3 are actually around these kind of minor issues where no part is actually changed. Then there are some where there are accident cases, which is nothing to do with the product. And then there are some which are product warranty cases, right? So between these three, an 80,000 number actually is not, per month is not bad for a 8 lakh unit in operation. If you assume a lot of it is just scheduled or minor queries.
Got it. That's helpful. Thank you very much and all the best.
Thank you.
Yeah.
The next question is from the line of Gunjan Prithyani with Bank of America. Please go ahead.
Yeah, hi team. Thanks for taking my questions. Bhavish, I just wanted to go back to the points that you made initially that EVs are at an inflection and market is growing. When I look at the numbers for Ola, of course, this is a business in nascent stages. I would ideally think that the base of volumes sold every quarter should consistently go up, right? So when I look at the quarter 2 volumes, clearly premium is something which is almost half from last quarter levels. And I'm just trying to understand, is it more to do with our focus on mass expansion? Just the number quarter 1 to quarter 2 volumes going down is something that if you can explain, how are we approaching that? Because this is an expansion market, right? I mean, it's a very nascent market at this point of time.
See, for us, for seasonal as well as some regulatory reasons, Q2 has always been a bit of a dip over Q1. So if you see FY24 also, Q2 was a dip over Q1. And FY25 also, Q2 is a bit of a dip over Q1. Now, there is a seasonality also in the industry, and also generally, whatever FAME reduction the government does is around the start of Q1 or the end of Q1. Last 2 years, that's been happening. So what happened in Q1 FY25 was a lot of the deliveries which were there because March end was the same changeover. So a lot of customers had ordered in March and the deliveries happened in Q1. But hence, I would actually say that you should look at a more broader time horizon where actually our numbers are going up. Just last month we sold, like we had said, we sold more than 50,000 vehicles in October. Even this month we are seeing a good growing traction. So I feel in general penetration is going up. Our position remains strong. We do have to expand distribution. That's a very clear focus for us. But quarter on quarter you should see growth over the next few quarters. Q2 over Q1 always is a bit of an outlier.
Okay, so I mean, the better way to look at it is just look at first half over first half. Is that the way? I mean, we should continue to expect like at least 25-30% growth on the base of volume.
See, my expectation would be about I think we would year on year aim to grow around 50-odd%. That's our aim. Some quarters it might be more, some quarters it might be less. 50+%. So now there is obviously a seasonality. So Q3 will always be a good season. Q2 will be a little weaker season. So I'm sure you will apply the seasonality discount whenever you look at it quarter on quarter.
Okay.
The other comment, Gunjan, was from you on premium versus mass. So mass has obviously helped increase penetration. Our focus is to let both of our portfolios, premium and mass, grow in the market. We are not really worried about cross cannibalization since gross margins are broadly similar. And premium, like I mentioned, also makes about just about 52% of our revenue. I think overall, majority of our revenue comes from premium. Now, looking ahead, also even after Q2 in October, we've had generally similar ratios. The premium continues to also grow, while mass is really the one growing significantly.
Okay, got it. That's useful. The other thing that I wanted to get your thoughts on are these, regular schemes. Now, whenever, particularly BOSS, when it got launched, I mean, it just tends to create a lot of nervousness around how you're thinking about the margins because these are clearly very high discount schemes, right? So, I mean, how should we think about these recurring schemes coming back to the market and then, we sort of getting nervous about, is it chase for market share? How should we think about margin? If you can share your thoughts on this as well, please.
Absolutely, Gunjan. So, see, our directional commentary on this is we will balance between growth and profitability. But given the balance, gross margins will continue to improve quarter on quarter because, like you saw, even in Q2 over Q1, despite additional discounts in Q2, we had discounts around our Concall event, we had discounts around our IPO period, we had discounts in September a little bit. So despite more discounts in Q2, we still kind of had a flat gross margin. So like I said, 3 points went up due to BOM cost reduction and 1 point we invested back in addition to into pricing and discounts. Now in Q3 also, we are while we are investing into discounts, our general direction would be that quarter on quarter gross margin will incrementally go up only. So we are seeing BOM cost savings even while Gen 3 will come in next quarter. There are other lot of vertical integration activities that are playing out, which continue to every month actually keep improving our BOM cost and hence improving gross margins. And then some of that we keep investing into pricing and discounts. Our strategy is to continue to gun for strong penetration and market leadership. And like I said, we have a very significant BOM cost advantage over competition, which is only increasing. So, while we are investing from our margins, I think at some point competition will actually have to see how they invest from balance sheet versus their gross margins from this product. So to summarize, you can expect increasing gross margins despite discounts.
And fair to assume that the savings that you will get from the Gen 3 as well as the battery vertical integration, I mean, roughly around 25 is, I think, what you've quantified. At least 30-40% of that goes in terms of reinvesting, in terms of, making the pricing better, enhancing the adoption. Is that a broader way from a midterm perspective to think of it?
See, our focus is to have a gross margin of about 30 plus minus %, right? Now that's where the ICE industry also broadly operates. So at that levels, with a very much more efficient front end due to the B2C nature of it, we actually believe our EBITDA margin will be in the mid-teens at a certain volume scale. Right now, we are almost at that volume scale, and that's why quarter on quarter you see our segment EBITDA in the negative single digits roughly. So if there is higher competitive intensity in a quarter, we might invest a little bit more, but we will keep focusing on growing the headroom on the gross margin so that we can invest out of gross margin. So that's the overall direction I would share on that.
30 by when, Bhavish? Is there a timeline around it?
No, Gunjan. Not a timeline, but specifically if you see Gen 3, like I said, is starting January. And there will be a full, it will start January. Not all savings will be in January, but as all the ideas on Gen 3 roll out through the next calendar year, we will get about a 20-point savings from today's gross margin. And then on top of that, the cell starts in Q1 FY26. Again, not all of our vehicles will start with our own cell on day one, but there will be a 1-2 year period when step by step different vehicles will come onto our own cell. So that's a step-by-step journey. It will take a couple of years, and I'm not giving any time commitment on it. And also there is an open market dynamic which as market competitive dynamics evolve, we have the wherewithal to continue to be aggressive while maintaining a certain level of profitability.
Got it. Just last, if I can squeeze in for Harish, I think PLI is what I just want to get a sense on what part of the portfolio got PLI in this quarter. Maybe if you can quantify that as a percentage of revenue in quarter 2.
Yeah, Gunjan, hi, Harish here. So on the PLI front, last year we got our Air PLI certified and Pro certified in February. And in this quarter, the entire X portfolio, 2, 3, 4, they all got PLI certified during the course of the quarter. Few of them happened in August and 1 or 2 happened in September. So as of now, this quarter, we'll have the entire PLI for the full quarter across the portfolio.
I think in Q2, there was about a 5% as PLI. Yeah. So PLI is about 5% of revenue, which is accounted for in the gross margins.
All right. Thank you so much.
Thank you. The next question comes from the line of Yogesh Agarwal from HSBC. Please go ahead.
Yeah, hi guys. A couple of questions. Bhavesh, firstly on Gen 1 versus Gen 2 and Gen 3, you talk about cost advantage. But what's your views on general quality improvement? Were you negatively surprised with Gen 2 issues, and are there any learnings for when the Gen 3 comes? Are you expecting lower issues? So what are your views on that?
So Yogesh, if you think of our product quality is actually in terms of number of defects per 100 vehicles or amount of warranty replacements, etc., broadly in line with EV industry within India and even globally, broadly in line. Gen 2 is actually better than Gen 1. That's why I said in FY24 we had a certain warranty cost. In FY25 we'll have slightly lower than that, and that's because of the Gen 2 transition. Now in Gen 3 we have also focused on further making many reliability, quality, serviceability improvements in the product, fairly significant ones actually. And for example, one thing, the hub motor is actually a very higher prone to quality issues. So we're actually in Gen 3 moving to a complete mid-mount motor across the platform, which actually helps reduce cost also, as well as helps improve quality significantly. There's almost a factor of 10 just in the motor quality over there. So many such things which have helped improve quality in Gen 2 and then further in Gen 3. So we do expect further reduction in warranty costs on Gen 3.
Okay, great. And then other thing is, Bhavesh, just curious from your views on the long-term brand and the product positioning strategy. The ASPs have been falling, right? And it's probably in line with your COGS, but they are still falling last many quarters now. And this is led by all these flash discounting and mass market products. So, and we have seen in the past, once you go down that curve, it's very tough to upgrade the portfolio as well. So, is it something you worry, or volumes and cost are paramount here?
See, we think of firstly product and then volumes, and brand is an outcome of product experience of the customer, ownership experience, and obviously at the scale at which you do it. So that's how we think of this. And see, our premium products are holding very good. Our market share in the premium, let's say the S1 Pro or the S1 Air segment is fairly high, and even the product is much better than what anybody has been able to build so far in competition. And there are very strong loyalist customers. Many of them have brought multiple S1 Pros, S1 Airs, etc. So I personally don't worry about the brand going down. One of the reasons for ASP is going down, and ASP is actually probably a wrong proxy to think of in terms of brand, because ASP is going down for two reasons. One is a mix, which you rightly said. Second is actually just as FAME is reducing over the last 2 years, that FAME has come out of revenue. Right. So for the whole EV industry, FAME would be falling, and hence ASPs would be falling.
Very well. Thank you so much, Bhavesh.
Yeah.
Thank you. The next question is from the line of Rishi Vora with Kotak Securities. Please go ahead.
Yeah, hi. Thank you for the opportunity. Bhavesh, just on the mass market portfolio, right? Obviously, on a sequential basis, we have seen a double-digit volume growth. But now, given that where our pricing is versus the iScooters, when will that next leg of growth, as per you, will come through? Because I think our models are there in the market for last 2-3 quarters. So, what is stopping the customers to, now shift from ICE to EVs, given that even now the upfront cost is maybe similar or lower in some cases?
So, Rishi, like I had mentioned in my opening remarks, we actually believe there is EV penetration inflection that is happening already in the scooter industry. There were 2 or 3 key drivers for this, and many of them have come in place over the last couple of quarters, and some still have to be done over the next couple of quarters. Firstly, purchase price parity. Now, that is all done more or less, especially for our portfolio. And a better cost of ownership for EVs with a purchase price parity is a very compelling proposition, and customers are starting to recognize that. Second is distribution penetration. Now, while we have 800 stores or so, competition is now selling in more stores, about 3,000-4,000 each of them tell in their analyst commentary. But, our stores sell much more because we have the best product at the best price. Now, as we expand our stores to 2,000, we actually believe we will be much closer to customers for them to truly experience the best EV product and at the best price and the best overall package. So that's number 2. And third is also expansion of the service infrastructure for us. And service infrastructure in EV is also not just an Ola problem; it's an industry problem, because training the mechanics in EV battery maintenance, motors, electronics, all these are new things, software. So we are investing effort into doing this, which is, I believe, probably the last leg of confidence the customer needs. We don't see any major concerns or questions around charging in this ecosystem because two-wheelers are not very dependent on public charging. Now, all of these things are coming together. In many states, for example, I told Rajasthan has 47% scooter penetration, EV scooter penetration. And this is our estimates of the scooterization of the Rajasthan market. UP, Madhya Pradesh are around, I think, 35%. Maharashtra, Karnataka are around the 25-30%. So these are the states which are large enough states and yet have high scooter EV penetration. And this penetration has actually happened in the last 6 to 9 months as our mass market portfolio has come on. So we, as now we have almost 1 million units in operations, 8.5 lakh or so. More people are seeing their friends, or more people are getting more confident. So it's a matter of, again, just all these things falling in place. And these all different themes actually compound on each other, right? So that's where you are seeing already an inflection in EV penetration. I have a chart on in my shareholder letter on page 5. If you see, it'll show you how in the last 1 year we have grown. The industry has grown EV penetration, despite in the same time FAME subsidies falling from almost 60,000 to 10,000. Right, so it just shows how the industry and the penetration is growing.
Understood. And just on the premium portfolio, right? Well, I do understand the seasonality part, but even on a YOY basis, our volumes are down 26%, and this is despite, I think, our pricing being lower than what it was a year back. So, is there something which we need to be concerned about, or it's something which you think is a very quarterly phenomenon that should start normalizing in the subsequent quarters?
This is a quarterly phenomenon. I wouldn't be too concerned about it. There will always be some cannibalization when we launch mass products, which we have. And from our vantage point, like I said, we are not. And my commentary to all of you would also be that don't assume mass products have lower margin. That's why if you see, even though the ratio in Q1 FY25 and Q2 FY25 has changed, yet the gross margin is actually flat. And that's because broadly the gross margins are in the same zone for us, broadly, few points here and there. So, and for us, premium, many customers were buying premium EVs earlier, but they wanted a product for TCO. So now there's mass market products for them. But parallelly, what's also happening is many customers who were buying, let's say, 125 to 150cc motorbikes slightly, mid-market motorbikes are actually buying the premium EV scooters now because better performance, better torque, better functionality of a scooter versus a motorbike in urban areas. So there are many market dynamics which are very hard to forecast beyond a point. And that's why our strategy and effort is to just let these products be in the market. There will be some cannibalization the premium portfolio will do of motorbikes. Some it will grow within the premium scooter segment. The mass scooters will cannibalize our premium, but the mass will also much largely cannibalize the ICE scooter segment. And even actually the mass is cannibalizing the ICE motorbike segment. We were looking at some data.
And just last question on the distribution side, right? So, before our IPO, our experience centers were at, I think, around 935. Currently, we are at 782. And in our RHP, we had guided that we'll add 300 experience centers by FY26. And now, why there is a change in strategy? Is more because of pressures or is this?
See, the 900 to 780 odd was just, some real estate which was not performing. We removed that. And then we consolidated our stores into the performing ones. And all these stores are performing well. Like I said, the average is about 130 odd per quarter, which is 2 to 3 times the industry average. Now, when we were planning our expansion, we actually had initially thought we'll do more incrementally, a few hundred. But we're now seeing that the EV penetration is actually at this inflection point. So we now actually want to go deep into many markets. For example, let's say, while in urban centers we have enough stores, but let's say in a city like Bangalore, we have about 25, 30 stores. Whereas an incumbent two-wheeler company might have 70, 80, 100 stores. So we will do some densification. We don't need to be 1:1 because our productivity per store is much higher. And then even if you think of other tier 2 cities, let's take my hometown, Ludhiana, the whole district, we have only about 1 to 2 stores in the whole district. And incumbent ICE company will have about 7 to 10 stores in the whole district. So there are places where, the closest Ola store is about 50, 60 kilometers away. Yet, these are towns with 1-2 lakh population. There is enough two-wheeler sales over there. And as our motorbikes are also coming in, we feel we have the product portfolio to now go into upcountry in terms of distribution. So that's the overall thinking, and hence we decided to allocate some more capital to a faster expansion.
Understood. Thank you and all the best.
Thank you. The next question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Yeah, hi. A couple of questions from my side. One is, we have talked about 20 percentage point reduction in cost due to Gen 3. Would it be possible to give some breakdown? How do we come to the 20% number? Where are the savings coming from within the BOM cost?
Jinesh, there's actually a very nice video in the shareholders letter, which maybe offline you can see if you haven't seen already. It will give you a very good conceptual architecture of the Gen 3 platform. But some highlights are we're doing a re-architecture of the motor platform, which reduces cost, increases power density. We're doing a re-architecture of the electronics platform to lower the number of ECUs into smaller, largely a single board. We're doing some very, very cool work on batteries as a structure, which takes away some layers of plastic. We're doing some very interesting work on the way the mechanicals, the fabrication of the vehicle happens in the factory, which reduces the manufacturing cost. We're doing more automation in the factory. We're doing more vertical integration, some things which we were outsourced to suppliers. Like, for example, the motor tier 2s, we might bring some of those things also into our own manufacturing because we see a very quick return on capital on those things. So all of these added up get you the 20% savings. More specifics, we won't be sharing each idea, but you can assume each of these broad categories of mechanicals, electronics, powertrain, etc. All of them add up.
Got it. And effectively, by next quarter, 3Q, our PLI should go up from 5% to 13%, given all our products have been approved, which are there in the market today. Is that the right way to think about PLI?
Harish?
Yeah, it will see the entire quarter we have PLI approval for all the products in Q3 and Q4. Now, exactly 30, because there are also slabs in PLI. Actually, it can go higher than 13% based on which slab you hit on the top line, etc. So I think that minimum 13% on the product is given.
Yeah, so we should be getting the full benefit. Got it. And with respect to the cell manufacturing, which will come from 1Q FY27, 1Q FY26, what kind of savings do we expect? I mean, where are we in terms of our current cell cost, which has been imported? And what would be the cost of manufacturing for us for the upcoming cells?
Sure. See, on cell, I will actually comment first on the segment P&L. So because you'll have to look at the cell segment P&L differently and the automotive segment P&L differently at that point. But if I give you right now a consolidated number, see the cell at a gross margin level will be much more profitable on day one versus procuring from outside. But there will be some costs we will be incurring for scale, which will be we will grow into that as the cell production scales. So roughly about 5 gigawatt-hour is when our own cell production will be much cheaper than procuring from outside. And that's the 7 to 8 points of savings further. So that will happen by the time we get to about between 3 to 5 gigawatt-hour.
Got it. And lastly, can you talk about the capex plan for FY25 and FY26?
So on the capex plan, what we have also highlighted in our book and continue to engage on that is that there is a cell project which is currently happening. You note that we have completed 1B is in progress. Then that will be followed by scaling up from 5 gigawatt-hour onwards, for which around 1,200 crore has been already raised in the IPO. See, that's the current roadmap from now for FY25 and FY26, and then beyond 5 later. The auto side, there is obviously new product launch which are happening, the motorcycles, the three-wheelers we spoke about. That will require a certain level of capex, followed by capacity expansion from the current 1 million onwards to 2 million. So these are the largely broad buckets of capex is where the investment will go into the coming couple of years.
If I add to that, Harish, on the product development capex, there are two things. One is the factory expansion, and second is actually the R&D or the investments on the tooling, etc., which is more on the product things. So our factory expansion is, listening to the factory is already built out for much larger scale. The factory expansion capex will not be similar to what we have done so far, so that will be much more tapered down even as we increase volumes. But for each new product we build, there will be some capital expense across tooling and testing and some homologation, etc., etc.
Right.